$170 million loss to America's #1 bank. That's not just a banking problem. This could ripple into creating a major issue for loans, for cars, for even insurance, and going forward cause a giant ripple. This is an article from The Street about JP Morgan Chase where he actually comes out and says that he thinks that the industry could be in some really hot water. So JP Morgan reported that there's a $170 million charge-off tied to something called Tricolor Holdings. That's a subprime auto lender, and that's where we're seeing some articles start to talk about the auto industry is dead, the auto industry is dying, all those things. But yet another company, the First Brands Group, that's an auto parts supplier, also filed for bankruptcy. So part of this wave of auto-related bankruptcies coming from 2025 going into 2026 is causing some major issues. Now, how does that tie to insurance? That causes the cost of parts, the causes of lack of loans, the insurance companies not be able to insure properly. They're going to have to raise some of those prices to keep up with this. But more importantly, we're diving a little bit under the blanket here to find out what the information is, because the CEO actually said when you see one cockroach, there's probably more, meaning that one major failure surfaces, there's probably more that are coming. Warning that there was a credit bull market, and I agree that you're getting loans for all things that technically you normally wouldn't qualify for, actually the last decade. And it's looser lending. Those standards have been looser since 2010. That's going to cause a lot of personal bankruptcies, which is going to affect the new vehicles, the parts, all of those pieces. What does this matter to the auto industry? Well, the subprime lenders, that's like Tricolor, those low credit borrowers, they're going to have those rates go up. And if that's the case, they're going to see probably a 30 to 40% increase since the last few years that they've had those decreases. It has been going up. And that wave of bankruptcies, those lenders, they might tighten credit. They might be harder for people to get loans on vehicles. It might reduce the car sales. It might hurt the auto insurers that are insuring those cars because of those reasons. They'll keep older cars on the road, which is a higher claim, higher risk, higher cost. Even with Tesla coming out with their new self-driving cars, all of those factors, it's going to be harder to get them. And if that's happening, we've seen this before. In 2008, there was a financial crisis, and that was the subprime auto loans and home loans that started to collapse. Now, I'm not a financial guru. This is an insurance channel, but I also am in this industry, and I think it's important for us to know how that it's going to affect the consumer. The harder the loans are, the banks are going to raise credit. Their standards for borrowing money is going to go down or raised, so that's harder to get. There's going to be higher risks for insurance, which is going to cost you more. The premium impact for the rates are going to remain high, even though that the risk might change. You've got the repair inflation is going to keep elevating, and that's just going to keep going up, right? You're going to see a financial strain, so people might shop aggressively. That's good for us because we do insurance. So if you're looking for the description below, but you're only be looking for cheaper coverage. And one of our biggest things is trying to educate people that it's not always the cheapest coverage that's going to protect you correctly. Yes, we want both, cheap and good company, good fit, good pay on claims, have a good agent. All of those things are what everyone's looking for, but it's going to make it harder because some of these companies won't be able to give those good rates as good as they have in the past. Now, rates have been going down, and keep this trend going, please. It's not a ton. We've seen 30, 40% increase in the last 5 years, but we're starting to see a 2 to 5% decrease in the last 12 months. So we're seeing some of these things go down, and it's because of the risk, not because of the financials. So this is going to maybe flip that back to where we're going to see another 10 to 20% increase. We don't know yet until everything processes through. If there's more cockroaches, this could be a problem. The used car market is going to spike. Whenever the new car market goes down, people are looking for used cars. So if you have used cars, stock up on your used cars. You can sell them for 20, 30% more, and that's good for the used car market. What does this mean for insurance agents? So insurance agents, you're going to see a lot more shoppers. So if you have a big book of business, a lot of customers, you're going to see them start to shop. They're going to come to us. We're here to help, right? We try to push them back to you if you're a good fit for them, but if it's not the fit, then it's not the fit. You're going to see that with 2025, people are going to shop even more. They're already seeing 35 to 45% of everyone that has insurance today has shopped in the last 12 months. So almost half of everybody has shopped over the last 12 months. And we might see that increase if this happens. You're going to see the cheap insurance options because money's tight. They got to lower their coverage. You got to be able to pay for it, right? So if you can't pay for it, then why even have it, right? You're going to see more uninsured motorists happen. And the smart people are the ones that want to protect themselves. They're just going to lower their coverage. They're going to take on more risk, which could turn out to be a really big negative for some people. But the overall option is that or nothing. And having that is going to be a better deal than having nothing. More lapse. You're going to see more late payments, more chasing customers, more trying to reshop people, more trying to reduce their coverages, more reevaluation. So it's going to create a lot more work for no extra money. And that's part of what you signed on for. You got to take care of the customer, but that's going to create a lot more hand-held holding than it has in the past. So the good is I kind of see this as a negative, but it could weaken some of the lenders, the smaller lenders, so it creates a stronger, stable market. But I don't like that. I want the younger people to grow, the newer agencies to grow, the newer lenders, the newer mortgage brokers, the newer car loan people. I want them to kind of come into the industry and disrupt. I want this not to be just this guy holds all the cards. I'd like that market to be competitive. It's going to push automakers to focus on quality and affordability. So they're going to make sure that their cars are really good seen in the eyes of the consumer, but they're also cost effective. So if that happens, that's going to give us more rebates. The time to buy a car is going to be in a few years. And so that's going to be a really good deal. The problem is you just can't get a loan. It could, in the financial model, create more of the pay per mile. That's starting to happen a little bit with some of our carriers where they offer a lower cost for your insurance and then you pay per mile that you drive. So driving less, there's less risk. All of those things are happening. The con to this is that the consumer, you and me, are going to have a lower borrowing activity where we can get more loans and we're going to have higher costs, higher APR, higher all of that. The dealers and the suppliers are going to struggle. So there's going to be job cuts. I actually just saw that GM's cutting jobs this morning, and that's part of it. Gambling will go up. The insurance might grow slower, even though I think we're primed perfectly because most of our agents are 60 plus and people are shopping. So when those people are retiring, they're not wanting to have junior take over their policy. And that's something that's being passed on. And that's causing a market to where we can be competitive and we can showcase who we are as an agency. Let me know what you think. Do you think we're heading in for an auto credit crunch? Is this one, a bad apple? Or two, is this something that you see the cost going up? Do you think this ripple is going to filter into all of these insurance industry, the auto industry? We're already seeing layoffs with the new cars. What is your take on this? This is a new type of video that I wanted to make that isn't directly around insurance, even though it directly affects your insurance and what you pay. And is this something that you think is going to impact us in the next decade to come? Let me know your thoughts in the comments below. Otherwise, I'm Mark with Think Insurance. I'll see you in the next one.